The world of investing is full of numbers. Investors are always looking for clues. One number stands out. It's called the PE ratio. But what is it? And why should you care? Let's unravel this mystery together. The PE ratio is a powerful tool. It helps us understand the relationship between a company's stock price and its earnings. The PE ratio is a valuation metric. It tells you how much investors are willing to pay for every dollar of a company's earnings. It's like a price tag for earnings. A high PE ratio suggests investors are optimistic. They are willing to pay a premium for future growth. A low PE ratio might indicate undervaluation or lower growth expectations. The formula is simple. PE ratio equals market price per share divided by earnings per share, or EPS. Let's calculate the PE ratio for company XYZ. Imagine company XYZ is trading at $50 per share. Its earnings per share for the past year were $5. The PE ratio would be PE ratio equals $50 divided by $5, which equals 10. This means investors are paying $10 for every $1 of company XYZ's earnings. We can calculate the PE ratio in two ways, trailing and forward. The trailing PE ratio uses past earnings. The forward PE ratio uses projected future earnings. Trailing PE ratios are based on historical data. Forward PE ratios are based on estimates. For example, imagine company ABC has a trailing PE ratio of 15. Analysts expect its earnings to grow by 10% next year. Its forward PE ratio would be lower, reflecting the anticipated growth. Section 5. The PE ratio's significance: unlocking value and spotting overpriced stocks. The PE ratio is a powerful tool for investors. It helps identify potentially overvalued or undervalued stocks. A high PE ratio might suggest a company is overvalued, while a low PE ratio might indicate undervaluation. However, it's important to consider other factors. Industry differences, growth prospects, and market sentiment play a role. Section 6. Beyond valuation: the multifaceted roles of the PE ratio. The price-to-earnings ratio, commonly known as the PE ratio, is a fundamental tool in the world of finance and investing. While it is often used as a quick measure to gauge whether a stock is over or undervalued, its applications extend far beyond simple valuation. The PE ratio is not just for valuation. It serves as a versatile metric that can provide a wealth of information to investors, analysts, and financial professionals. By examining the PE ratio, one can gain insights into various aspects of a company's financial health and market position. It's also useful for industry comparisons. When comparing PE ratios across different companies within the same industry, investors can identify which companies are potentially undervalued or overvalued relative to their peers. This comparison can highlight industry leaders and laggards, offering a clearer picture of the competitive landscape. Comparing PE ratios within an industry provides insights. For instance, a company with a significantly higher PE ratio than its industry average might be expected to have higher growth prospects or superior management. Conversely, a lower PE ratio could indicate potential issues or market skepticism about the company's future performance. It helps investors understand relative valuation. By looking at the PE ratios of different companies, investors can make more informed decisions about where to allocate their capital. This relative valuation approach can be particularly useful in identifying investment opportunities that might not be immediately apparent through other metrics. Furthermore, the PE ratio can indicate growth potential. Companies with high PE ratios are often those that are expected to grow rapidly in the future. These companies might be in emerging industries or have innovative products and services that are anticipated to drive significant revenue growth. High-growth companies tend to have higher PE ratios. Investors are willing to pay a premium for these companies because they believe that the future earnings will justify the higher price. This willingness to pay more reflects the market's confidence in the company's growth trajectory. Investors are willing to pay a premium for future earnings. This premium pricing is a testament to the market's optimism about the company's potential. However, it's important to note that high PE ratios also come with higher risks, as the expected growth may not materialize as anticipated. Lastly, the PE ratio reflects market sentiment. The overall PE ratio of the market can provide a snapshot of investor sentiment. A high average PE ratio suggests that investors are generally optimistic about the market's future prospects, while a low average PE ratio might indicate caution or pessimism. A high average PE ratio for the market suggests optimism. This optimism can be driven by various factors such as strong economic indicators, positive corporate earnings reports, or favorable government policies. When investors are optimistic, they're more likely to invest in stocks, driving up prices and PE ratios. A low average PE ratio might indicate pessimism or fear. This could be due to economic downturns, geopolitical uncertainties, or disappointing corporate earnings. In such times, investors may be more risk-averse, leading to lower stock prices and PE ratios. Understanding these market sentiments can help investors navigate the complexities of the stock market and make more informed investment decisions. Section 7. The PE ratio's limitations. A word of caution. While the PE ratio is a valuable tool, it has limitations. Relying solely on the PE ratio can be misleading. It's crucial to consider other factors. Different accounting methods can affect earnings. This can impact the PE ratio. Additionally, the PE ratio doesn't account for debt. Companies with high debt levels might appear cheaper than they are. Section 8. Putting it all together. A real-world example of PE ratio analysis. In this section, we will delve into the practical application of the price-to-earnings ratio, or PE ratio, by comparing two hypothetical companies. This will help us understand how investors use this metric to make informed decisions. Let's compare two hypothetical companies, Company A and Company B. By examining their PE ratios, we can gain insights into their market valuations and growth expectations. Company A has a PE ratio of 25. This means that investors are willing to pay $25 for every dollar of earnings that Company A generates. A higher PE ratio often indicates that the market expects significant growth in the future. Company B, on the other hand, has a PE ratio of 15. This suggests that investors are willing to pay $15 for every dollar of earnings that Company B generates. A lower PE ratio can indicate that the company is more stable, but with slower growth prospects. At first glance, Company B seems cheaper because its PE ratio is lower. However, it's essential to consider the context behind these numbers. Company A is a high-growth technology company. These companies often have higher PE ratios because investors expect rapid growth and are willing to pay a premium for that potential. Company B is a mature utility company. Utility companies typically have lower PE ratios because they are considered stable and generate consistent earnings, but their growth prospects are limited. The difference in PE ratios reflects their growth prospects. Investors are willing to pay more for Company A's shares because they anticipate higher future earnings growth compared to Company B. Investors are willing to pay a premium for Company A's growth potential. This premium is reflected in the higher PE ratio. In contrast, Company B's lower PE ratio indicates that it is valued more for its stability and consistent earnings rather than high growth. Understanding these nuances helps investors make more informed decisions when comparing different stocks. Section 9. Mastering the PE ratio. Practical tips for savvy investors. The price-to-earnings ratio, commonly known as the PE ratio, is a crucial metric for investors looking to gauge the value of a company. It compares a company's current share price to its per-share earnings, providing a snapshot of what the market is willing to pay today for a dollar of earnings. But how can you use this ratio effectively to make smarter investment decisions? Let's dive into some practical tips. To use the PE ratio effectively, consider these tips. Compare within industries. The PE ratio can vary significantly across different sectors. For instance, tech companies often have higher PE ratios compared to manufacturing firms due to their growth potential. Therefore, it's essential to compare the PE ratios of companies within the same industry for a more accurate assessment. This approach helps you understand whether a company is overvalued or undervalued relative to its peers. Compare the PE ratios of companies within the same industry for a more accurate assessment. Combine with other metrics. While the PE ratio is a valuable tool, it should not be used in isolation. Other financial metrics such as the price-to-book (PB) ratio, return on equity (ROE), and debt-to-equity ratio can provide additional insights into a company's financial health and performance. By combining these metrics, you can form a more comprehensive view of a company's valuation and make more informed investment decisions. Don't rely solely on the PE ratio. Use it in conjunction with other financial ratios and metrics for a comprehensive analysis. For example, a company with a high PE ratio might seem overvalued at first glance, but if it has a strong ROE and low debt levels, it could still be a good investment. Conversely, a low PE ratio might indicate a bargain, but if the company has poor earnings growth and high debt, it could be a value trap. Use it in conjunction with other financial ratios and metrics for a comprehensive analysis. Analyze historical trends. Another important aspect to consider is the historical PE ratio of a company. By looking at the historical PE ratio, you can understand how the company's valuation has changed over time and identify any patterns or trends. This historical perspective can help you determine whether the current PE ratio is justified based on the company's past performance and future growth prospects. Look at the historical PE ratio of a company to understand its valuation over time. For instance, if a company's PE ratio has consistently been higher than its industry average, it might indicate strong investor confidence and growth potential. On the other hand, a declining PE ratio could signal potential issues or market skepticism. By analyzing these trends, you can make more informed decisions about whether to buy, hold, or sell a stock. The PE ratio is a powerful tool for investors. By understanding its nuances and using it effectively, you can make more informed investment decisions. Remember, the PE ratio is just one piece of the puzzle. It's essential to consider the broader context, including industry trends, economic conditions, and company-specific factors. By doing so, you can develop a more holistic investment strategy that maximizes your chances of success. By understanding its nuances and using it effectively, you can make more informed investment decisions. Now it's your turn. What are your thoughts on the PE ratio? Have you found it to be a reliable indicator in your investment journey, or do you prefer other metrics? Share your experiences and insights in the comments below. Engaging with fellow investors can provide valuable perspectives and help you refine your investment approach. What are your thoughts on the PE ratio? Share your experiences and insights in the comments below. Whether you're a seasoned investor or just starting, understanding and effectively using the PE ratio can significantly enhance your investment strategy. So take the time to analyze, compare, and combine this metric with others to make well-informed decisions. Happy investing! Share your experiences and insights in the comments below.